The reverse repo facility. This is a cash account at the Federal Reserve that people have been watching very carefully for a few years now, and for good reason. What I'm about to demonstrate in this video is that it is finally headed back down to zero. Despite the fact that for the last couple of months, it has been entirely flat, we will now see that it will resume its move downwards and hit zero, and we're going to discuss the reason why this is important and the implications it's going to have on the economy and the markets. The reverse repo facility started sucking cash into it in March of 2021. This was when the supplementary leverage ratio suspension expired, which meant suddenly banks needed to be concerned about how much collateral they had to offset their deposits. In other words, their liabilities. At the time, the Federal Reserve did not want them going to the open market and buying T-bills when rates were near zero because of all the cash that had been printed into the system. Going out to buy those T-bills would have pushed rates negative. So the Federal Reserve incentivized banks to place their cash with them in the reverse repo facility. They would get a nice little interest rate on their cash and be able to get collateral that they needed in return. This arrangement sucked $2.3 trillion of cash into the reverse repo facility up until May of 2023. Because as a financial institution, a bank, money market fund, why would you not want to get risk-free return on your money that pays above the Fed funds rate, perfectly liquid, and you don't even have to keep it locked up for a month or 2 months like you would with a T-bill. But as you can see, all that started to change halfway through 2023, and cash started to drain back out of this facility. So what changed? Well, the Federal Reserve had been raising rates for that entire time, but suddenly they raised rates to a point where if the US government wanted to be able to borrow short-term debt, they were suddenly going to have to pay about 5.4%. When the government borrows at these short-term rates, this is done through something called T-bills, and you can see T-bills even now are paying in between 5 and 5.5%. This is important because if you have cash, you have three needs for that cash. Number one, you need the highest interest rate possible. Number two, you need the highest liquidity possible, meaning you need to be able to access it. You don't want it locked up. Number three, you need the lowest risk possible because you don't want to wake up one day and find your cash is worth zero. For a few years, the best place to get that trifecta was with the Fed's reverse repo facility. But as soon as the federal government started paying 5.4% to borrow for 1 month or 2 months at a time, it changed the equation. Suddenly, you're sitting on cash, you're willing to take on 1 month of having your cash locked up or maybe 2 months of having your cash locked up by taking it out of the reverse repo facility and buying a T-bill instead. You'll get a higher rate and just a little bit less liquidity and basically still the same amount of risk. So as the government started borrowing at the short end of the curve by issuing T-bills, it started sucking more and more cash out of this account from a high of $2.3 trillion in May of 2023 to the current level of just over $400 billion. The reason why the federal government would rely on borrowing with such short-term debt is because recently, when they try and borrow with long-term debt, like a 30 or a 20-year treasury, they have auction problems, but more on that later. You might be wondering why the drain in the reverse repo facility has stalled for the last couple of months. Well, it has to do with the reason why the drain was happening in the first place. Remember, money is taken out of the reverse repo facility by financial players because they're able to put it into T-bills, which they can get a higher rate on. And so if the government is not issuing T-bills, then the highest rate possible for the trifecta of liquidity and interest rates and risk is still going to be at the Fed's reverse repo facility. So why would the government over the last 2 months be issuing less in T-bills, borrowing less at the short end? Very simple. It's tax season. The government only borrows money as the difference between what they bring in, or I should say what they take in taxes, and what they spend. So during tax season, like March and April, they're bringing in most of the tax dollars they're going to bring in for the entire year, which means during that time, they don't have big borrowing needs. So the cash that's in the reverse repo facility is just going to stay there, and it'll enjoy the high interest rate, low risk, and immediate overnight liquidity. liquidity. Now, if you're a smart cookie, you might know that April 15th is a tax deadline, which means tax season is officially over and the government is no longer going to be receiving above average tax revenues. This means that unless spending drastically drops, they're going to have to start borrowing again, at least at the pace they were borrowing before. And given the fact that at the short end of the curve, they're borrowing at a rate that is higher than the Fed pays to its reverse repo facility, it means the cash will continue to come out of the reverse repo facility and it will go to buy T-bills instead. This gives us about 60 days, maybe a little bit longer, maybe a little bit shorter, until the reverse repo facility hits a big fat zero. Now you can see the reverse repo facility has been at zero before and we didn't have any issues as a result of that. But we're dealing with an entirely different set of circumstances now than we were back then. One thing that is relatively different now than it was before is that the government has had big problems borrowing at the long end of the curve recently. For the last 6 months, anytime we've seen a 30-year, 20-year, 10-year treasury, we've been seeing larger and larger tails. This is a very bad sign with government debt auctions. Very simply, the size of the tail just represents the difference between the interest rate the government wanted to borrow at and the interest rate they actually had to borrow at. The larger the tail, the worse the auction. We're seeing fewer and fewer dollars, fewer and fewer lenders line up at those auctions, which means the government is spending more and more money on interest every single time they borrow. It's getting to the point where very soon we could see a failed auction, which is why the government relies on issuing T-bills right now so much, because they have this massive slush fund. They can borrow an unlimited amount at the stated interest rate. They don't have to worry about paying higher and higher rates or having a failed auction when they borrow with T-bills, because they just suck cash out of the reverse repo facility. But there's only about $400 billion left in there. Given this fact that tax season is over, it's gonna suck the rest out fairly quickly. And this could have big implications for asset prices and for the economy as a whole. And if you're looking for a way to profit off of this situation and the volatility and change in asset prices that it could cause across various asset classes and industries, I want you to save the date on your calendar. This Thursday, April 25th at 7 p.m. Eastern time, I'm going to be going live for an asymmetric trading masterclass. And this is your last chance to sign up. I'm not making another video before that. I've been using asymmetric trades in my own account to take home big gains over the last 8 to 9 months. And then I rolled that program out to a group of beta testers with fantastic results. And on this Thursday, I plan on sharing all of that with you. Essentially how to be able to profit with very, very minimal risk of loss on volatility and changes in asset prices, both up and down, that happen across the market. I'll even do a live Q&A at the end of the call to answer all of your questions. This masterclass is completely free, and all you have to do to sign up to attend is click on the link in the description below, submit your email, and I will see you there. By the time you see this, there may only be a few days or a few hours left to sign up, and spots are filling up quick. So click the link below, and I look forward to seeing you at the event. So what are some of the implications of the reverse repo facility hitting zero and the government no longer being able to rely on this massive slush fund of hundreds of billions of dollars to borrow from for short-term debt? The first implication is a lack of liquidity in the system. If you think about this like a riverbed, you aren't able to see all of the risks that are underneath the water, like alligators or rocks, because there's a lot of water. The risks are hidden. But when liquidity dries up, you see all the cracks in the riverbed. You can see all the crocodiles that are waiting there to bite you. Those are the types of risks that are hidden right now, which is why it's always important to stay prepared when things seem calm, when there are risks mounting, but it seems like the market and the economy are just shrugging it off and acting like everything is fine. A lack of liquidity in the system can cause all sorts of problems that are unexpected and unpredictable, from defaults to flash crashes and bankruptcies. Oh, and speaking of bankruptcies, over the last year or so, we have already started to see a massive uptick in corporate bankruptcies. One of the causes for this is the crowding out effect. Corporations don't have access to the cheap capital that they thought that they would or that they needed because the government is soaking it all up. For a thought experiment, imagine for a moment that the government was paying 20% on all of its debt, which means that you could loan money to the government. You could buy a treasury for 20%, guaranteed, 10 years. How much money do you think you'd keep in the stock market? When you have risk of total loss and you're maybe gonna get 8-9% a year, nobody would keep any money in the stock market. Everybody would sell it all and loan it to the government instead, and asset prices would crater. Not to mention the fact that if you wanted to borrow for a car loan or a credit card, or if a business wanted to borrow for investing in their company, they would have to pay at least 20% because They had to pay more than the risk-free rate so that they can attract lenders because they have a higher rate of risk than somebody who can use the force of law and the threat of violence to collect to pay. And when this thing hits zero, they'll no longer be able to just pay 5.4%, but will have to start paying higher and higher amounts to attract capital from wherever else it is. And this is true on the short end of the curve as it is on the long end of the curve. And given the fact that Wall Street is now expecting that interest rate cuts may not even come at all this year, we are at the very least going to see interest rates move higher and stay higher for longer as a result of this reverse repo facility being drained and the effect that that has on the rest of the economy through the crowding out effect. But in addition to that, we are also very likely to see increased volatility, maybe flash crashes, unexpected moves happen in the market, bankruptcies and defaults emerge as the liquidity gets drained from the system. And that's why it's always important to stay prepared, especially at the times when you see risks mounting, but it looks like the market is shrugging it off. Because number one, that protection and that preparedness is cheapest. And number two, because by the time you're sure that you actually need it, it'll be too costly and it'll be too late. So stay hedged, stay disciplined, happy investing. Thanks for watching. Have a great day.